there real quick. Um, Purse Strings is here to provide some free online just education. We always just want to provide some knowledge and skill for our communities of women out there. And then when you need a professional to go put things in transition or transaction, you're going to go through a divorce, you're looking to retire, you want to pay off some debt. We have professionals who specialize in serving the female market, really want to be there on your team. And we call those our Purse Strings approved professionals. Diane Robinson is one of our Purse Strings approved professionals. And today she's going to be sharing her expertise on the IRA and the Roth IRA and kind of giving us the details in there so we can figure it all out and really understand what it means. But before we dive into all that fun, Diane, could you tell us who you are and what you do?
Well, I'm Diane Robinson. I'm an investment advisor with IP Financial Advisory Services, and I've been doing this for quite a while.
Awesome. Awesome. Well, we're excited to have you on today. And just to remind everyone, if you ever have any questions, just pop them in the chat. Even if you're watching the replay, we'll make sure we get back to those. So let's dive in. Let's just start with, can you just explain, what's the difference between an IRA and a Roth IRA, just before we dive in?
Well, let me explain what an IRA is in general. It is a retirement account that allows you to save for retirement on either a tax-free or tax deferral basis. So when you look at IRAs, there's actually three different types. There's a traditional IRA, which can be a deductible or non-deductible IRA. So let me explain the difference between the two. If it's a deductible IRA, that means you're making contributions on a tax deferred or what's called a pre-tax basis. If it's a non-deductible traditional IRA, you're making contributions on a non-deductible basis, and that's after tax. So I always like to give a little example. So let's say that your wages are $50,000 a year, and you want to put $5,000 into a traditional IRA. If it's the deductible IRA, it will go on your tax return. So on your tax return, you'll have income of 50,000, but if you're putting it into a deductible, which is a pre-tax IRA, then that $5,000 is not counted as income for you. So basically, you're paying taxes on 45,000. Now, if it's a traditional IRA that's non-deductible, and we still have the same $50,000 in wages, and you put 5,000 into the IRA, it's after tax, which means you have to pay taxes on it. So the $50,000 will show up on your tax return, and that's what you will be paying taxes on.
Okay.
Now, the next one is the Roth IRA. The Roth IRA, you make contributions with money that you've already paid taxes on it. So that's after tax. So it's similar to the non-deductible. So if you have 50,000 in wages and you put 5,000 into a Roth IRA, the Roth IRA does not show up on your tax return, and you pay taxes on the 50,000 of wages. Now, the other types of IRAs are called rollovers. So there's a, excuse me, a rollover IRA or a rollover Roth IRA. So a rollover IRA is you have money that you've contributed into a qualified retirement plan, like a 401k or 403b. So you're rolling that money over into the IRA. Now, the Roth rollover for a 401k, you're taking that 401k and you're rolling it over, excuse me, into a Roth IRA.
Okay. So what would be then kind of, it definitely seems like it's all around taxes and how, it's taxed before or taxed after. And so why would someone do, let's say, the non-deductible IRA versus a Roth IRA?
Well, most people do the deductible IRA because they want the tax deduction. But a lot of times, the Roth IRA may be a better choice for you because you pay the taxes up front. So as long as you keep the Roth IRA for 5 years and you're over 59 and a half, then all of that comes out tax and penalty free. Whereas with an IRA, if you take it out before age 59 and a half, then you're going to pay penalties and you're going to be paying taxes. Because you can pay taxes on the IRA going in, everything that's in that IRA that comes out is going to be taxable. And on top of that, you may have a 10% penalty. So if you got $50,000 and you have to pay a 10% penalty, you're actually getting 45,000 instead of 50,000.
Right, right. That makes a big difference.
Mm-hmm.
So how can people contribute to their IRA or their Roth IRA?
Well, first of all, you have to have earned income, and the income has to be either from employment or self-employment. So the first thing you need to do is to determine which type of IRA you want to do. Is it going to be the IRA or the Roth IRA? And then the second thing you look at is your age. So if you're younger than 50, then you're allowed to put up to $6,000 into the IRA or the Roth IRA. If you're 50 or older, they have what's called a catch-up amount, and that's $1,000. So you can put an additional $1,000 into that IRA or that Roth IRA.
Okay.
Now, so determine which one you want to do. You pretty much have to ask yourself some questions, or work with someone like me who asks you the questions to help you determine which one's best. I happen to like Roth IRAs for a lot of people because there's some very good reasons for that. The Roth IRA, as long as you have the money in again for 5 years and you're over 59 and a half, that money comes out tax free. So when I'm working with my clients, I like to make as much of their retirement income not taxable.
Yeah.
Because if you have to pay taxes in retirement, that's less money you're going to have to live off of. So a Roth IRA will do that. Also, people don't realize that once you get Medicare age 65, and you have to go on Medicare, your Medicare premiums are based on the income on your tax return.
Really?
Yes. So when someone who's going on Medicare, let's say next year, 2023, the they will look at not your 2022 tax return, they'll look at your 2021 tax return, because you start Medicare, let's say you started January the 1st of 2023, there's no 2022 tax return to look at.
Right.
So they go back to the 2021. Now, if you have income on that 2021, let's say you had $100,000 in an IRA, and you took that, you took 30,000 out. That 30,000 could conceivably push you into a higher tax bracket, or it could affect how much you're going to be paying for Medicare premiums. And right now, Medicare premiums are around $174 per person. So if you get put into a higher tier, you might be paying 200, 300, 400,000. And I've seen that happen because I've had people call me and say, why is this person having to pay, higher Medicare premiums? So when I talk to them and find out maybe they sold a business and that income is showing up on that tax return, so that can put them up into the highest tier for Medicare premiums, which is $400 or $500 per person.
Wow.
So, so when I'm dealing with my clients, I always try to get them as much non-taxable income for retirement. Now, for the IRA, maybe you need the tax deduction. Maybe you're in a higher tax bracket and you can use the tax deduction. That might be a better choice for you in that situation. But the thing with the traditional IRAs is that when you take that money out, you're going to be paying taxes on all of it if it's all pre-tax. Now, it could be that some of it's after tax and some of it's pre-tax. But if it's pre-tax, then you're going to be paying taxes on that, and it's going to show up on your tax return.
Okay.
And that when you hit age 72, you're going to have to take what are called required minimum distributions. So that means you're going to have to take money out of your IRA. If you don't, you're going to pay a penalty of 50%, and you still have to take the money out.
Which is huge, 50%.
Right. So let's say you had your minimum requirement distribution was, let's say, 3,000, and you didn't take it out. Well, now your tax on that, or your penalty on that, is 1,500. So yeah, so it's important. Now they're talking about raising that to 75, the age of 75, but that hasn't happened. So for right now, it's 72. Now with the Roth IRAs, as long as you've had it for 5 years and meet all the other requirements, you don't have to worry about RMDs.
Okay. I get that required minimum distributions,
Mm-hmm.
just in case somebody didn't catch that out there.
Well, if they want to know why they're doing that, is the government, you put the money in and didn't pay taxes on it, so they want the taxes.
Yep, of course. That's always how it works, is they
Mm-hmm.
want their tax money. And so what do people do if they don't work and don't have an earned income? How do they contribute to, their IRA or their Roth IRA?
Well, there are ways to do that. If you're married, you can do a spousal IRA.
Yeah.
So what you need to know about that is that you have to be married. You have to be married on December the 31st of the year that you're doing the IRA or the Roth IRA. So if you wanted to do a 2022 IRA or Roth IRA, you could do that as a spousal IRA, provided you're married on December 31st, and the person that you're married to has enough income so that you can qualify to do that. When I say enough income, let's say you put the 5,000 in, but your spouse only earned 4,000. And if you're doing a spouse, and it's even for you, if you're doing the IRA on your own, if you're putting 5,000 in, but your earned income is only 4,000, you can only put 4,000 in. So that's
Right.
the same with a spousal IRA too. Your spouse has to have earned enough money that you for the amount that you're putting in. Now, the other thing that you have to know is that if you're legally separated or divorced, you're not eligible to make contributions.
Because you aren't making an income.
Right. Yeah. Yeah. If
Yeah.
you're trying to do a spousal IRA, you cannot do that
Right.
if you're legally separated or divorced. So ideally,
Okay.
you want to do your own IRAs. And this is a bone of contention with me for women. We get so tied up in what we're doing and worrying about everybody else that we don't plan for retirement. And that
Yeah.
has to change
Yeah.
because we're outliving the husbands. And, even if we're not, we still need to worry about our retirement because I don't know about everybody else. I don't want to have to go back to my daughter and say, I didn't plan for this. And so guess what? You're going to have to support me. And her answer
Right.
is probably going to be, what? And she's not going to be happy about it. So there are other reasons why women need to get off their fannies and start getting involved in this. And I know they're busy, but this is something that is important, and women need to treat it as something that's important.
Yeah, you have to put yourself first and get smart about your money. We're big believers in that. And um, I was going to say that the spousal IRA is something that we suggest a lot to like stay-at-home moms or things like that. So their retirement can continue to be funded and it's money in their name. Because stay-at-home moms know you're not getting paid, but it's still a full-time job for sure.
Right. And there are also other sources of income that you may be able to use to qualify for this. One is taxable alimony.
Okay.
I don't know if people realize this, that they changed alimony, and it was last year, maybe the year before, I don't remember which. So now it's not taxable because you don't claim it on your tax return, and the person paying the alimony cannot claim it as a deduction on his or her tax return. Now, if you have alimony agreement from prior to that, you may be able to use that as income, qualified income for an IRA or a Roth IRA.
Wow.
And
Okay, that's a great piece to know.
right. And so if you have combat pay, that may be help you be able to qualify for doing that. And that's under the HEROES Act. You may be able to use accrued vacation pay if you're working, director's fees, jury fees, but I don't know any jury fees that are high enough to warrant that, but you could. And sometimes scholarships or fellowships can also qualify you to be able to do an IRA or Roth IRA.
Oh, those are all great pieces of advice to know because, yeah, it's not always just income from a job. There's so many ways to actually have income. And so it's great to know that there's more options out there.
Right. And you also have to double check because things change. Maybe it's allowable this year, but maybe next year it's not. Or maybe next year they'll add something else.
And that's why we say you should have a professional because they'll be filling you in on all of this. And that means you don't have to do the research or everything else. They're just kind of there to help you out and be the knowledge experts.
Now, there are other ways that you can fund an IRA or a Roth IRA. And I don't think people may or may not know this. You can always contribute to an existing IRA or Roth IRA. You can use your tax return to fund an IRA or a Roth
Oh,
IRA.
that's smart.
Yeah. So, but if you're going to do it from a refund, you need to know the rules and you need to work with your tax professional because if you don't do it correctly, you're going to have headaches.
So can someone contribute to their IRA even if they have like a 401k or a 403b?
Sure, you
Um,
can. Yep. Um, so you just have to, qualify under the rules for the IRAs and Roth IRAs, and you can.
okay. And so I know you were talking about some penalties that are out there for the IRA and Roth IRA, and one of them is the age. of when you can start pulling out the money,
Mm-hmm.
correct?
Mm-hmm. It
Are
is.
there any other penalties that people should know about when using this money or trying to pull it out?
Um, no, you really have to look at, are you going to have to pay taxes on it?
Yeah.
Is there going to be a penalty? And you need to factor those things in. So, like I said, I try to, when I'm working with my clients, give them as much non-taxable income for retirement.
Yeah.
So the Roth IRA, again, is a great way to do that, because as long as you meet the guidelines of the 59 and a half years old and the 5-year requirement, it comes out penalty and tax-free.
Okay.
You
Awesome.
can't beat that for retirement.
Right, right. Which is nice to know exactly kind of how much money you're going to get, not just kind of guesstimating it, but knowing that there's a tax going to be taken out.
Right. And then with the traditional IRAs, it's always penalty free after 59 and a half. But if you have a non-deductible IRA, traditional IRA, you need to know that you've already paid taxes on part of that. So what taxes you're going to pay is on what your earnings are on that. So that's for a traditional IRA that was non-deductible. Now, for a traditional IRA that was deductible, the entire amount's going to be taxable. So you need to plan that. So if you need a roof and you want to take $20,000 out of your IRA, you need to look at your taxes. You
Yeah.
need to talk to your tax professional. Is this going to put me into a higher tax bracket? How much am I going to pay in taxes and penalties? You need to look at those things.
Yeah, it's all a domino effect, which is, you don't always see right away, but then you start doing the paperwork later and it's like,
Mhm.
oh, sometimes you don't know what you don't know. And that could be the biggest problem out there.
Now, there are exceptions to the 10% penalty. So let me pull that up so I don't miss all of them, but
Okay.
there's 11 of them.
Oh, wow.
Yeah, there's 11 of them, so I don't want to miss all of them. So the first one is obvious. You have an IRA, you die. You leave it to, your beneficiary and estate, so there's no penalty on that. Hey, go figure, huh? So the next one is you become totally disabled or permanently disabled, you can avoid the 10% penalty as well.
Okay.
Now, the next one's a little more difficult, so let me see if I can use an example to explain it. It's called the 72T. So basically what it means is you're taking a distribution as a part of a series of substantially equal periodic payments for your life or your life expectancy. You understood that correctly? Yeah. I mean, that was clear, right?
I think you got some money till the end of your day.
So basically, here's what it is. You can actually take the 72T before you're 59 and a half, and it will help you avoid the penalties. But so let's say you have $100,000 in an IRA and you want to take the entire IRA out, but you don't want to pay penalties on it. So you could set up what are called a series of substantially equal periodic payments. But the thing you have to know, it's based on your your life expectancy or your life. Now, the next one, you can actually take a distribution penalty free for a qualified first time home purchase. It
Really?
cannot be in excess of $10,000.
That's good to know. So you could take out 10 grand to start funding your first home.
Right, you could, yes.
Wow. That's a great benefit, especially for the younger ones out there.
But like with everything else, I always caution you, make sure you qualify and you know what you're getting into.
Right. Exactly. Exactly.
Now, so for parents of college age students, you can actually take a penalty-free distribution for qualified higher education expenses. Now, the caveat on this is that you cannot take out more than what the actual expenses are. So if your child is in college and their expenses for the first semester or the first year, 10,000, and you take out 20, that 10,000 is going to be penalty. You have to pay a penalty on that.
Yep. And it's always that interesting dynamic of having parents help pay for the schooling, but we always want to make sure that they still have enough for their own retirement because, the student has more time to make up that money and has different options where retirement is just going to be there and you've got to take care of yourself.
And again, I'd like to point out, this doesn't mean that you don't have to pay taxes. This is
Right.
only the penalty that we're talking about.
That's a good
Okay.
point to bring up.
Yes. So the next one is you can actually take a distribution penalty free to pay for health insurance premiums. But there are stipulations to this. You can only do that after you've received unemployment compensation for 12 consecutive weeks or would have been eligible to receive unemployment compensation because you were self-employed. So,
Oh,
so for it to be penalty free, it cannot be in excess of certain health insurance premiums.
that's a good one to know, but a great helpful tool to have.
Yes, it is. And I think that's the reason I bring this up, because I think
Yeah.
most people don't realize that they have this benefit. And
Right.
it kind of
No.
is a benefit, um, but you don't want to use them if you don't have to, because you want the IRA, the Roth IRA, to be there for retirement, because that's the
Right.
intent of it. Now, since you can use premium, pay it for insurance premiums, you can also use it for unreimbursed medical expenses. Now, this one's a little tricky too. So you can't take a distribution penalty free that's in excess of your unreimbursed medical expenses. And on top of that, you have to worry about how much is going to be counted on your tax return as unreimbursed,
Mm.
because medical expenses are deducted on your Schedule A, which is your itemized deductions. And the IRS has a little twist to that. So
Of course.
yes. So if let's go back to that $50,000 or wages you have. For your medical expenses to be deductible, they take that 50,000 and they multiply it by 7.5%. That's an exclusion, so you can't count that. So if it's 50,000 and you look at 7.5% of that, that's $3,750. So if you have 10,000 in qualified medical expenses, you would have to take that $3,750 off of it, and all you'd really have to be able to deduct would be the $6,250. Now,
Okay.
again, I'm not here to give you tax advice. I'm just giving you an idea so that you know you need to talk to your tax professional.
Right. Right. I'm glad you reiterated that again because it is so important.
It is. Yes. So really, you need to be working with your financial advisor and your tax professional for a lot of these things, just to make sure that you got your I's crossed, your I's dotted and your T's crossed.
Exactly. And introduce them to each other.
Mhm.
Because they
Yes.
want to work hand in hand with each other. And so the first time I kind of heard that, I was like, what? But then, yeah, introduce them
Yes.
all together and they're going to all work as different spokes kind of on your wheel to make one holistic picture, which is so important.
Now you're going to love the next one.
Let's hear it.
You can take a distribution penalty free to make um, to be made directly to the government to satisfy the IRS levy of the IRA.
Can we have that in English, please?
Um, Again, you need to talk to your tax professional, but basically what it is, okay, so um, let's say for some reason the IRS puts a levy on your IRA. You did something you weren't supposed to do, or maybe you owe back taxes and they're taking that. I don't know. I'm just reading it to you.
Yeah.
So, but anyway, you don't have to pay penalty on the amount of money you use to satisfy that IRS levy.
The IRS just wants their money.
Right. So you need to talk to your tax professional, the IRS, if you can get a hold of the IRS,
Yeah,
and
right.
get a better definition of that one. But that's my understanding of it.
Awesome. That's great to
Okay.
know.
The next, you can take a penalty-free distribution if you're a qualified reservist.
A reservist.
Mm-hmm.
Oh, because you were in the reserve.
Right.
Yep. Okay. That
Now,
makes sense.
by the way, you can find this on the IRS website. You just look for the publication that has distributions from IRAs, and it'll come up and tell you. So they're all listed there, and they can change. So you want to make sure that you're actually eligible for what you want to do. So the next one, I think everyone should be familiar with this. You can take a penalty-free distribution if the federal government declares that your area is an emergency or disaster. So for the people that had the flooding and they lost their homes, say in Kentucky, they can actually take a distribution penalty-free from their IRA or Roth IRA, so that they have some money.
Interesting. That's really good to know.
Yeah.
I actually had no idea.
Oh, see, I thought that one was more familiar.
Yeah. But that's great to know because, things like that happen and you just didn't always plan for it. So having that extra money is always helpful.
Right. And, it's nice that you don't have to pay a penalty on it.
Right.
It's not,
Exactly.
it's not nice that you have to actually take the money because you need it, but you don't want to add insult to injury, and that will
Right.
definitely do that. Okay, and the last one that I have is if you have a qualified birth or adoption, you can take a penalty-free distribution that's not in excess of $5,000.
Okay, that's good to know.
So those are the 11 exceptions. Again, you can find that on the IRS website. They have it there, so you can look there if you have any questions on it. But those are the ones that they have listed.
Yep. So it does seem like the penalties can really get you, but there are ways to kind of get around it if needed to pull that money out a bit sooner,
But that
which we're
means
not.
but that means you need to talk to your tax professional and you need to talk to your financial professional.
Exactly, exactly. And they can help you with that situation and make sure, it's really the best option for you and your family and your financial situation. Um, Diane, you were just a wealth of knowledge over there.
Well, I wanted to do something a little different. I didn't want to just
Yeah,
be, run of the mill advisor.
definitely. One of the questions I've come in is what's kind of the difference then between like an IRA and your 401k? How are those different?
Well, the 401k is an employer plan. So the
Got it.
employer sets the rules to it. I mean, and it falls under ERISA. I don't know if you know ERISA, but 401ks fall under ERISA. And so do IRAs and other things do too. But the 401k falls under under ERISA. So there are certain guidelines for that. So the employer uh, picks the plan that you're going to have, and so what happens is you have money taken out of your paycheck that goes directly into the 401k.
Hmm.
Now you can put it into a traditional 401k, and some companies will now allow you to put it into a Roth 401k, and you can split that if they allow it. Um,
Okay.
the important thing to know about this is that let's say you have that $50,000 of wages again, and you put
Hmm.
5,000 into your 401k. At the first of the year, when you get your W-2, line one will say, okay, taxable income. It will be 45,000 because you put the 5,000 into your 401k.
Yeah, that's important to remember.
Okay, the other things that you need to know is that, the employer and the company may have different guidelines. They have different funds that you can choose from. Like I said, you can have both. You can have a 401k, you can have a 403b and have an IRA. You can have a 401k and have an IRA or Roth IRA.
Okay.
So, but the big difference is that the 401k is an employer provided benefit. And sometimes the employer will match what you put into there. And so that's an added benefit for that. And that's something you cannot get from an IRA or a Roth IRA. So if you work for a company that's giving you a match, please put in enough to get the match. That's free money. Why
It's
would you
free
pass
money.
it up?
Exactly. And that's usually at like 2.5, 5%. So
It might be 3%.
yeah.
The other thing is usually they have it on a schedule. So if they're doing a match and let's say the schedule is for 5 years and you leave before then, you may not get all of the match. You just get a portion of it. But if you
Right.
meet for 5 years or 7 years, then it's yours. So
Yeah.
it's
And that's a
kind of a
good thing
way
to
for them.
yeah,
Yes, kind
just
of
to
a
kind of
way for
remember.
them. Mm-hmm.
You might want to stay that extra 6 months if you're at that 5 year mark,
Right.
just about there. And, that way you could get more money in the long run.
And companies are using 401ks now as a way to attract employees.
Yep.
It's competitive out there, so they need something to attract you. So a 401k is a good way to do that.
Yep. There's all these different benefits these days. So we have to look at the full picture, not just always the take home salary, but yeah, how they're matching and the other benefits that they provide.
And you also need to know that there's the 59 and a half rule too, as for the 401ks.
Awesome. That is important to know. I feel like we've covered a ton of great information. Are there any last items that you want to make sure is shared with our community today?
Oh, there's lots of things I could say, but that would take a while. So I'd be happy to answer any questions.
All right, let me see if any other ones are coming in right now. Um, yeah, so much great information is the comments I'm getting because it is just a wealth of knowledge. Um, I don't think there's any questions right now at this point, but there might be later when people watch the replay. But I appreciate you coming on and giving all this great information.
Well, thank you for having me.
Of course. And so if people have questions or want to reach out, you can always reach out to Diane. Her email's going through the bottom down here. And she's also one of our Purse Strings approved professionals. So you could check her out on our site, pursestrings.co. And she could help you set all this straight for you and making sure that you're, not getting the penalties and making sure it all is working for you, as well as working with your tax professional.
And I have a couple other things, if you don't mind.
Yeah.
My website is jdianerobinson.com. So there's videos on there. There's newsletters. There's almost anything that you could want. Also, there's a way that you can contact me through there. So if you would like a copy of a brochure it's from Franklin Templeton, this one is, with this information on it, I'd be happy to send it to you. So just put in the body of the email, IRA brochure.
Awesome. That would be a great resource to have. So email Diane for that. And we will be back in 2 weeks to have another Money Monday. So until then, have a great weekend. Bye.
Bye.